On Wall Street, fortunes are built that can rival entire nations. We hear these stories of genius traders, right? People who seem to turn everything they touch to gold. But what happens when that golden touch fails? Sometimes those same empires can just vanish with terrifying speed. Today, we're going into the hedge fund graveyard. We're going to do an autopsy on some of the most catastrophic financial collapses to figure out exactly how they happen. Okay, let's start with a number, $6.5 billion. Just let that sink in for a moment. That's an almost unimaginable amount of money.
And get this, that wasn't a loss spread across the whole market or even a bunch of different funds. Nope. That was the value erased from the books of one single, supposedly brilliant hedge fund.
And here's the real kicker. This financial nightmare didn't happen over a year. It wasn't a slow bleed. It happened in about 30 days, 1 month, a complete and total wipeout. So you have to ask, right? How on earth do the smartest guys in the room manage to lose so much money so incredibly fast? Is it just terrible luck? Some freak black swan event? Or is there a pattern, a recipe for total financial ruin? Well, that's what we're here to find out. It turns out these massive meltdowns, they're almost never random. They are usually built from the exact same 3 toxic ingredients. And if you can understand these 3 things, you can understand pretty much every major financial blowup we've seen. First up, you've got leverage. Now, think of this as financial steroids. You're using borrowed money to make your bets way, way bigger. So a small 10% gain can turn into a massive 100% gain. Amazing, right? But it also means a small 10% loss can wipe you out completely. It's a brutal double-edged sword. Next, we have concentration risk. This is where confidence spills over into pure recklessness. Instead of spreading your bets around, you decide to bet the entire farm on one single idea. If you're right, hey, you look like a genius. But if you're wrong, it's game over. And the third ingredient, and this one's a little more subtle, is liquidity risk. This is the trap of being too big for your own good. You buy so much of an asset that you basically are the market for it. So when you need to sell, guess what? There's nobody big enough to buy it from you without the price absolutely cratering. It's like being the only one trying to run out of a crowded theater through a tiny door. So let's see how these ingredients get mixed together in the real world. Our first case study, the story of Amaranth Advisors, a massive hedge fund that made a fatal bet on the weather. The key here is the cult of the star trader. This guy, Brian Hunter, was on an incredible hot streak. The fund got so confident in him, they pretty much threw their own risk rules out the window. What started as just one part of their portfolio slowly became the entire firm's identity. One giant bet on one guy's ability to predict natural gas prices.
And just look at how fast this all went down. It is absolutely stunning. At the end of August, they're a huge, successful fund. By September 7th, you can see the panic in their internal emails. One trader literally wrote, "It feels like it just tipped overboard on risk." A week later, the margin calls start piling up, and by the 21st, it's over. The fund is dead, and more than $6 billion has vanished into thin air.
Okay, so Amaranth was a story of a huge, visible risk. But our next case is way more sinister. It's about risk that was hidden in plain sight. This is the wild story of Archegos Capital. So, Archegos used this really complex tool called a total return swap. Here's a simple way to think about it. Instead of buying a stock, they'd pay a bank a small fee, and in return, the bank would give them all the profits or losses from that stock. This allowed Archegos to build these monumental positions in just a few companies without anyone knowing. The crazy part? All the big banks lending them billions had no idea that their competitors were lending billions for the exact same trade. So what happens when that kind of hidden, leveraged bet goes wrong? Well, when the handful of stocks Archegos was betting on started to fall, the entire house of cards collapsed. We're talking an estimated $20 billion of market value just wiped out. A personal fortune built over decades, gone in a weekend. And unlike Amaranth, this explosion wasn't contained. The damage spread like a virus. I mean, look at these numbers. Credit Suisse lost $5.5 billion. Nomura, almost $3 billion. Some of the biggest banks in the world were totally blindsided, which just shows you how one person's hidden risk can infect the entire financial system. Now, our first 2 stories were about self-inflicted wounds, but this last one, this is about what happens when the risk comes from somewhere Wall Street never even thought to look. This is the story of a rebellion that started on the internet. So on one side, you have Melvin Capital, a big, successful hedge fund making a classic bet. They were shorting GameStop stock, convinced it was going to fail. But on the other side, you had this online community, r/Wall Street Bets. They saw that GameStop was one of the most shorted stocks out there, and they realized they could work together. They coordinated a massive buying campaign, creating what's known as a short squeeze, which forced funds like Melvin to buy back shares at insanely high prices just to stop the bleeding. The result was a total bloodbath for the hedge funds. In January of 2021 alone, Melvin Capital lost 53% of its value. The fund, which was once a Wall Street darling, never recovered and eventually had to shut its doors for good, a casualty of underestimating a brand new power in the market. So, after this grim tour through the wreckage, what have we actually learned? It's really tempting to look at these as just wild, one-off stories. But the lessons here, they are universal and they are absolutely timeless. First, the lesson from Amaranth couldn't be clearer. Liquidity risk isn't just some theoretical idea in a textbook. It's real. If your position is so huge that there's no one to sell to when you need to get out, you are well and truly trapped. Those on-paper profits are just an illusion. Second, all of these stories scream the same thing. A lack of diversification is a death sentence. Amaranth bet it all on one trader. Archegos bet it all on a few tech stocks. Melvin bet it all on the idea that retail investors didn't matter. In every single case, having one single point of failure brought the whole house down. And third, the ghost of Archegos is here to remind us to be paranoid about hidden risks. Those swaps they used masked the true scale of their bets. The lesson is simple. If you don't truly understand your total exposure, you cannot manage your risk. You're not investing, you're just gambling blind. And this isn't some new problem. This quote right here, it's from the analysis of a long-term capital management collapse way back in 1998, a fund run by Nobel Prize-winning economists. It's a pretty humbling reminder that financial markets have a very, very long memory, and hubris is almost always the deadliest ingredient of all. Leverage, concentration, and liquidity. It's the same fatal recipe served up over and over again, and each time the failure just seems to get bigger. These stories aren't just history, they're roadmaps of what not to do. They're warnings. So the real question is, will the next generation learn from these mistakes, or are we all just destined to repeat them?